Hello and welcome to this week's Week Ahead with me, Senior Market Analyst at City Index. My name is Fiona Cincotta. Thank you so much for taking the time to join me. As always, just if you do have any questions at any point during the webinar, then please do just pop them in the box for the webinar, and then I'll answer them as we go through. So excellent. As always, first thing I'm just going to ask you to do is read through this risk warning, and I will just put myself on mute whilst you do that, and then we can crack on. Excellent. So as always, we'll start by just bringing up the economic calendar. This is on the City Index website. What I've done here is, oh no, I haven't. I will though. Is just do this for next week, and then we filter the results, and then I've just put it as the high impacting events. So we're going to kick off the week on Monday. It was jumped straight in with some hard US data. We've got retail sales. Now they're expected to show that retail sales rose 0.3% after rising 0.6% in February. So that's still pointing to a resilient US consumer. This very much goes in line with what we've been seeing from the US consumer and from the US economy, that it continues to show resilience and even strength in some areas. You know, we've seen that the services, ISM services, remains in growth. We've seen that surprise return to growth in the manufacturing as well. Consumer sentiment is, you know, it's showing signs of improving slowly, although it's you know, not at any sort of historically high levels at all, but it is sort of moving or trending in the right direction. And this is all quite interesting because this is all happening despite inflation in the US remaining sticky. We've just had the big inflation data this week. It was something that unnerved the markets. We saw inflation in the US rise for a third straight month. It was hotter than expected. And I mean, given the strength that we're seeing in the US economy, perhaps that sort of stickiness and persistence in US inflation is really coming through on the back of that. So it does support the view that the Federal Reserve is going to need to keep interest rates higher for longer. And I think that's what's interesting is, you know, if we just have a look at what's going on as far as the Federal Reserve is concerned, just having a look here at the FedWatch tool, you know, we know that the market following the US inflation data has really pushed back on Fed rate cuts. And if we continue to get strong data, so, you know, strong data next week and going forward, then we could see the market continuing to really raise questions about whether the Federal Reserve will actually be able to cut interest rates at all, really, in 2024. So if we think about before the inflation data, the market was sort of looking at around a 50-50 probability that the Fed could cut rates in June. That has now been pushed back quite considerably. I mean, there's just around a 50-50 probability of a rate cut in July now. But this is the rate cut expectations for September. So really, you know, at the moment, we're probably looking like a September move, or at least that's what the market is pricing in. So we can see that we're sort of looking at around a 72% probability of a rate cut in September. So that's been pushed back quite a lot. And now what's happened is, as we push back on those rate cut expectations, that's obviously bullish for the US dollar. And if we take a look here, we can see exactly what's going on with the US dollar. So the US dollar has broken out of this range. This was the range that had been sort of trading in since really, you know, the start of the year, caught between that the 102.50 level and the 105 level, which was sort of the February high. This week, look, we can see here, you know, we've had that bullish engulfing candle there, and this we've got another bullish engulfing candle today. So, you know, these are really bullish signs. It's absolutely blasted out of that resistance, and it's testing now this level here. This is the one that we're going to be looking to see how it treats here, just around the 106. Are we going to get another breakthrough that level? Could we see some consolidation or even a rejection of that level? Just worth noting here that the RSI is in overbought territory, so we could actually see a period of consolidation after such a strong move higher. So that's what I'm going to be watching out for with regards to the data next week as well, is how the US dollar responds to this level around the 106. I mean, the chart is showing a series of higher highs and higher lows. So that does sort of suggest that, you know, it's in a bullish trend. We've also got, you know, the 50 SMA crossing above the 200 SMA and a golden cross. So, you know, these are some bullish signals, but as I said, you know, just got to watch for that RSI. Now let's also take a look at what all this means for, we'll have a look at the NASDAQ. Just bear with me whilst I get this up. So this is the NASDAQ. Again, you know, actually, to be fair, the NASDAQ has held up pretty well considering. We'll have a look at the Dow after, but it's still actually trading within that holding pattern. It's still trading within the range from the March low there, which is around the 17,750 level. Obviously, it still hasn't broken above the 18,466 level, which is the all-time high, but it's still within range, although we have been seeing this sort of, you know, declining in the RSI. So do just be careful for slowing momentum. But I mean, this is just preparing itself for a breakout trade. I wonder whether we're seeing sort of investors wait here for earnings season, which is obviously just kicking off today. So that might give more clues over, you know, whether these lofty valuations are actually got sort of any fundamentals behind them. So maybe that's what we're waiting for the breakout for. So as I said, let's just also have a look for, sorry, just to clarify that. So if you're looking for a bullish breakout, then we'll be looking for a break above the 18,466. That could bring 19,000 comfortably into focus. On the downside, a break below the 17,720 level could bring this level here, which is the February low, into focus, which is around the 17,162. Quick look at the Dow Jones whilst we're here. Oh, sorry, just bear with me. Okay, so again, you know, we can see here actually there's been this pretty big sell-off that's been taking place as we've fallen away from that all-time high of just below 40,000, broken below that, broken out of the rising channel to the downside, broken below this support here, which is the 18,550 level, which was the March low. Looking now to come down to here, which is the mid-February low, also the late, in fact, the January, almost late January high, and that's also the confluence with 100 SMA around the 38,000 level, also a round number. So that could actually be quite a key level to be watching. You know, RSI is down there, it supports more downside whilst it remains out of oversold territory. So let's just crack on with what else we've got going on. I'll come to earnings at the end. Right, so we've got some data from China. China has been massively in the in focus over the last couple of days. We've had Fitch ratings agency downwardly revise China's growth forecast. Now, if we just look ahead to what we've got for, sorry, they didn't downwardly revise the growth forecast, the credit rating, but I'll just come to that in a second. If we just have a look, we've got retail sales, industrial production, and GDP data from China. So there's a lot of data for us to be getting our head around, and also for clues over how that recovery in the world's second largest economy is going. As I mentioned, we had Fitch downwardly revise the growth forecasts this week, and they cited concerns over high debt levels and slowing growth. So we'll get to really have some views over whether that growth is actually slowing. Let's not forget that just over a month ago, we had China set its growth forecasts for this year, and it was expected to be at 5%. I think it was 5% was what they're aiming for. We can see that industrial production is expected to slow slightly, as are retail sales, but we've seen data come in last week, which was the manufacturing PMI, which actually was much stronger than expected. So that just raised some optimism that perhaps the recovery in China is actually taking hold a little bit more than perhaps we realized. But then we've seen data today where exports have fallen 7.5%, imports were also weak. And that's basically a signal that demand is slowing. Imports falling is a sign of domestic demand slowing. We've also had inflation data this week again, which was weak. It fell 1% month on month. So, there is these signs that perhaps the economy is struggling. But then we've also had Goldman Sachs upwardly revise its forecast for growth for China to 5% today, up from 4.8%. They follow a similar move by Morgan Stanley. So, this data is going to be really strongly, really very much in focus. Now, obviously, I think as far as when we sort of talk about China, there are a couple of areas that I like to watch. Firstly, for the Aussie dollar, US dollar, this is quite interesting. I mean, we've seen obviously this is the strength of the US dollar is also coming into play here, but we've also seen some weakness after the weaker than expected trade data from China failed to move above that 200 SMA. So we've seen this rejection here at 0.6630, falling down, finding the support here at that sort of March low, early March low, around the 65 level. Also the round number just topped up, couldn't make it above the 200 SMA, and so we've seen this really, quite an aggressive fall lower again. So this is again a bearish engulfing candle. This is the key levels here. We're looking for this zone here. It's between the 0.65 and between the 64.80, around there. I think if we get a fall below this zone, then that's going to bring 64.40. This is the it's going to bring 64.40, yes, which is the 2024 low, into focus. Now, if that level doesn't hold, we could see a much deeper sell-off in the pair. Buyers are going to really need to get back over the 200 SMA in order to mount any sort of recovery. But at the moment, I was going to say, it looks like we're just going to be testing these levels here. So we can see it's a level that's really sort of been quite in focus a couple of times across this year. So really going to be watching what happens there. Obviously, if we get some stronger than expected Chinese data, that could actually encourage a rebound. Obviously, if we get weak data again, then we could be looking towards those lower levels. The other one that I like to watch with China data is the UK 100, because that brings it's very resource stock heavy. So, obviously sort of metal prices and oil prices are greatly affected by sort of news surrounding China and the health of the economy. And the UK is, the FTSE 100 is very heavily weighted in resource stocks. Now, look, we've seen stronger resource stocks in the fact that we've seen oil trading higher. It's around 5-month highs. We've also seen base metals push higher. Copper particularly has been trading at around a 14-month high. All this has helped the FTSE 100 reach within a whisker of its all-time high today, in fact. So this was a level that was last seen back in February 2023. You can see that it broke above the this high here that was seen at the beginning of April of 1816, and it just almost got up to that. So, you know, I think if we do see some strong data from China, then that could help the FTSE gain above that level. Also, on the downside, the one that I'll be watching for is the 78.80 level. I think that's a pretty solid support that we've got in there. If we see a break below that, then, you know, that's going to negate that near-term upturn trend. The other thing that I think it's worth watching as well is just gold. Okay, so, you know, just with regards to I'll tell you what, we'll just bear with me. Let me just see if I can put it up. Oh, sorry, hang on. There we go, much better. Okay, gold. This is going to be one to be watching with everything that's going on with the China data, with the US data, with rate cut expectations, with geopolitical tensions. You know, even though we've seen the market push right back on rate cut bets, we've seen gold continue to bound higher. Now, I think this is really interesting because this is showing us that actually there are other forces which are overshadowing central bank monetary policy in the sense of interest rates and interest rates expectations. So we've also got safe haven flows on gold flowing quite strongly given the rising tensions in the Middle East. And we've also got some big central bank buying going on. And I think that's something that's really supporting the gold price, has been central bank buying, particularly with China and India. That's helped drive this rally higher. Even as we've seen, as I said, you know, the US dollar rise to a 5-month high, US Treasury yields increase. So, you know, it does feel like the fundamental case behind gold is still pretty strong, particularly as, you know, the Fed rate cut bets still haven't really come about yet, given that the market has pushed back now on rate cut expectations. Just be wary though, gold is massively overbought at this level. I mean, it hasn't been overbought like this for a very long time. So that would suggest that, you know, we really would expect to see some level of consolidation at this level. It rose to 2,400, nice round number. Wonder whether we're just going to see some consolidation at this level now that we've reached that lovely round number. I mean, the breakout has been phenomenal. It's really been quite textbook there as it sort of pushed across this level here, which, if we just look closely, is going to take us back to the previous highs. So, I mean, you know, I think what we need to be watching out for as far as gold is concerned, as I said, a bit of consolidation about these levels. If we get a break above 2,400, then 2,500 is likely to be on the upside. As far as support is concerned, minor support potentially at the 3,300, but below that there's not really much going on in the way of support up until the 22 level, which we saw in the beginning of March. So yeah, so I mean, I think actually, to be honest, it's going to take a move below 21.90 to even really negate that near-term uptrend. And, you know, we're not seeing a real sort of, you know, bearish move until we get down to below 2,000. So, you know, this is a very, very strong rally that we've seen going on. Right, so just getting back to the economic calendar with what to expect. No, time's ticking. So we've also got some UK data coming in. Okay, so we've got UK jobs data. We've got Bank of England Governor Andrew Bailey, but we've also got UK inflation data coming through. Okay, so this is going to be interesting to watch. Jobs data, you know, we have seen some resilience in the UK jobs market, which the you know, even this week, Bank of England policymaker Megan Green highlighted the ongoing strength and resilience of the UK economy as a concern, and that sort of is also helping to keep inflation sticky. Wage growth is starting to slow. There are some signs that UK jobs data or the labour market is at least starting to ease slightly. For example, we've seen that permanent staff starting salaries have eased to the growth in them has slowed to the slowest level in 3 years. Temporary staff hiring has also reduced quite considerably. So, you know, there are these little signs, particularly within industry data, that UK hiring or the UK labour market is starting to slow. But yeah, inflation, that's going to be the key focus for next week as far as the pound is concerned. Inflation cooled to 3.4% year on year in the previous reading, and that was actually cooler than expected. And the anecdotally and sort of, you know, as far as the OBR is concerned, as far as the Bank of England is concerned, there is an expectation that the inflation is going to cool back below the 2% in the coming months. So potentially even as soon as sort of April. So, you know, March data, if we see the continued trend lower of inflation, that could fuel expectations that the Bank of England might actually cut rates in June. Now, if we think about the pound US dollar, if we do see the Bank of England cut interest rates in June, and the market's pricing in about a 50-50 probability of a rate cut in June. But obviously this is a complete difference to or divergence from what we're seeing from the Federal Reserve. So, you know, whilst we've got the market reining in Federal Reserve rate cut expectations, with the Fed now only expected to cut really in September. That's after the UK. It's also after the Fed is only expected to cut in around under twice across the year. So the market's not even pricing in 2 rate cuts by the Federal Reserve anymore across this year, whilst the Bank of England, the market is pricing in just over 2 rate cuts this year. So that difference in rate cut expectations between the central banks is what's been driving this weakness that we've seen now in sterling US dollar. And look, we can see, I mean, this trend line, this is the trend line here that goes back to July last year. You know, it's struggled to move above that trend line. And then we've got this line coming down here, and this is where we've seen resistance around the 127.7 level, and then it's shot lower, breaking below that 200 SMA, which it had broadly been trading above really since the end of November last year. So that's quite a significant move. Now, obviously, we've broken below this level here, which is the 125.40 level as well. And now we're just testing here the 120, I think, what did it get down to? Here we go, 124.60. So if we get cooling, I mean, the RSI is also supportive of further weakness here. So, you know, if we get a break below this level here, then that's going to bring 124 into focus. I think if we get weak ongoing signs of inflation cooling and weakness in the labour market, you know, that's really going to bring 124 into focus, and especially if we see ongoing strength in the US economy and hawkish comments from the Federal Reserve speakers. So that's going to be a really key trade next week to watch, is going to be the GBP USD. So we've already looked at the Aussie, so that's the other one to watch. The other thing to keep in mind, obviously next week, it is earnings season. So we've got a couple of things to be looking out for. Bank of America, they're out on, so you've got Goldman Sachs are out on Monday, Bank of America out on Tuesday. Just remember, we've got US bank earnings is literally about to be released this week for JP Morgan, Wells Fargo and Citigroup as I am recording. So I think broadly speaking, what's going to be in focus here, you're expecting net interest income is going to be in focus, because yes, interest rates are going to stay higher for longer, but that means that banks need to pay out more on their deposits. But that does also mean that they receive more on loans. So net interest income is going to be in focus. Also, I think, as far as equity trading is concerned and capital markets, that could be doing pretty well, given that we've seen this tremendous run higher in the markets. Also, we're seeing signs of the IPO market just starting to really pick up again. If we think about it, we had the Reddit IPO, for example, in the last quarter as well. So, there are encouraging signs as far as the banks are concerned. There will be, I think, areas of concern could be real estate, commercial real estate as well. So just having a look at the chart here, trading above the rising trend line, hit this peak here at 38.35, fallen down. This test here is 36. That's going to be an interesting level. You've got the rising trend line supports, also the low for this week. Below here, watching out for around 35.40 level. This is the mid-March low, and then below that the 34-ish level. Other one, what else we got going? Can't forget about Netflix, can we? Netflix had a much stronger than expected report in the previous quarter. We had that massive jump in out of hours trading, again a very strong increase since then. It's been trading above this rising trend line. As far as Netflix is concerned, they've seen, this since we've seen this crackdown on password sharing, there's been strong subscriber growth. There's also been obviously the paid, the different tiers, the subscription tiers for the ad. That's also been boosting the bottom line. So there is a lot of encouraging noise coming from Netflix at the moment. Subscriber numbers, as always, very much in focus, as well as EPS. We'll be looking for a rise here on Upbeat results above the 640 level. I do believe that is the all-time high that was just reached at the start of this month. Let me just double check that for you, though. Don't want to be giving out false information. Because we do know that in 2021, no, you see, there we go, 2021 lockdown, it did actually push higher than that. So that's not what I was, no, but it's still very, very high. So let's just maybe, if we get a break above that price, then we'll be looking for the 700 level. I think really, as far as support, I mean, there is some modest support here around the 600 level maybe. It's also the 50 SMA and the rising trend line. But if we get a breakthrough that, I think a key level is going to be down there at the 530 level. So that is everything from me. Thank you very much for watching. If you've got any questions, then please do let me know, and otherwise I will see you next week. Thank you.